Hi, I'm Roger Montgomery from the Montgomery Fund, and welcome to this week's video insight. From the outset, I need to say that our track record when it comes to forecasting the economy and the stock market is mixed. Indeed, I expect we'll get it right about as often as we get it wrong. Our guess is as good as yours. Having said that, I'm about to forecast both. With that disclaimer in mind, it's worth sharing with you our thoughts about our current concerns for the stock market. Describing our stance as slightly less than cautiously optimistic is probably fair, but to maintain that stance, we'll need good results and positive outlook statements from companies this reporting season. We think there are 4 risks to currently elevated share prices. The first risk stems from the fact that we can't find much value among the companies we like that are very high quality. Indeed, some of the very highest quality companies are now trading at double our estimate of their values. This can't be sustained, usually. So let me clarify the first point. There are no companies that we don't already own that are high quality with clearly bright prospects trading at discounts to intrinsic value. So that's the first risk. The second one is one we've talked about a lot here, and that's China. The idea that China can transition from an export-led fixed asset investment-based growth to consumer-based economic expansion while maintaining current rates of growth of around 7% is illusory. Capital Research in London noted that second quarter fixed asset investment represented 80% of GDP growth, double the rate of the previous quarter. To us, that suggests that the rest of the economy has literally fallen off a cliff. And without fiscal reform, in other words, putting more income in the hands of the people, which would be resisted by a control-addicted party, the transition must lead to lower rates of growth than are currently being hoped for and experienced. The third risk to share prices is the fact that the Australian economy is at a high risk of recession as the stimulatory impact of the mining boom reverses. We note that online job ads in WA have declined by over 40%. And that's come as a surprise to many, but not us. And the final risk will either get worse or better, and that is second quarter US earnings, which we're in the middle of, are currently flat to lower when finance companies are taken out. In fact, revenue growth is 0 and earnings growth is negative. With all of those things in mind, our investment strategy still hasn't changed, and neither should yours. Focus on good quality businesses when they're cheap. At the moment, there doesn't seem to be a great number out there. I look forward to seeing you next week.